This week, the U.S. Treasury actually breached the U.S. debt ceiling of 31.4 trillion, which means that the U.S. Treasury will have to take extraordinary measures to keep the administration afloat over the coming quarters in the U.S. So is this a thing for financial markets? I actually think it is, due to the ramifications for dollar liquidity when the U.S. debt ceiling is hit. But this week, we're going to talk about the debt ceiling, and it sounds like we are stuck on repeat. It is a theme that we talk about almost annually as a consequence of the debt ceiling rule in the US. And this week, the US Treasury actually breached the US debt ceiling of 31.4 trillion, which means that the US Treasury will have to take extraordinary measures to keep the administration afloat over the coming quarters in the US. So is this a thing for financial markets? I actually think it is, due to the ramifications for dollar liquidity when the US debt ceiling is hit. The reason why the US debt ceiling matters for dollar liquidity is that the US Treasury is not allowed to hold a lot of cash idle at the Federal Reserve when the debt ceiling deadline looms. And you can see that when you watch the development in the so-called Treasury General Account, which is the Treasury account at the Federal Reserve. They currently hold just below 400 billion worth of dollar cash at the Federal Reserve. They're not allowed to hold that amount of dollar cash when the debt ceiling is hit. So they simply need to spend that cash idle before they take other measures. What they promise is that they will bring this general account down to the level it had when the latest debt ceiling legislation was signed. Joe Biden signed the latest increase to the debt ceiling in the very latter part of 2021, so in December 2021. And at the time, the Treasury General Account had an overall level below 100 billion. So it basically means that the US Treasury will have to bring down this cash buffer from levels just south of 400 billion to levels around 85 billion over the course of the next 2 to 3 months. That is interesting because you and I and commercial banks are on the receiving end of this dollar liquidity when the US Treasury draws down on its account at the Federal Reserve. So either commercial banks hold the liquidity or else the Federal Reserve holds the liquidity. And when the US Treasury spends the dollars at the Federal Reserve, they end up in private banks. And private banks tend to take extra risk when they receive extra dollar liquidity. It is a buffer for private banks when they receive more dollar liquidity. And on the margin, they can take extra risk in financial markets when they receive this cash buffer. So it matters for financial markets when the US Treasury empties this Treasury General Account. But there is a caveat, and that is the so-called reverse repo facility at the Federal Reserve. The reverse repo facility was introduced during the pandemic to ensure that money managers and other counterparts of the Fed had a facility to park excess dollar liquidity on when there was a lack of investable instruments for them. The average money market fund tends to invest in short-term bills. So when the US Treasury is no longer allowed to issue new debt, we should expect these money market funds to park a little bit more dollar liquidity at this reverse repo facility. So what they do is that they park liquidity at the Fed and they receive collateral in the form of, for example, a T-bill in return in this reverse repo. So when the debt ceiling is hit and the US Treasury no longer net issues new debt, we should expect a slight increase to this reverse repo facility as a consequence of it. And when this facility increases in size, it actually means that dollar liquidity is withdrawn from the commercial banking system. So it is a move in the opposite direction, liquidity-wise, relative to this drawdown in the Treasury general account. Net, we will still have a liquidity increase of, say, in between 250 and 300 billion over the course of February and March. And that is something to be aware of as an equity investor.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.